Richard Wyckoff, one of the most influential traders of the early 20th century, understood something profound about markets that most modern traders still miss today. He recognized that price alone tells only half the story. It shows what happened, but fails to reveal the force or conviction behind the movement. Have you ever watched a stock chart in disbelief as it suddenly reversed direction, leaving you wondering how some traders seem to know exactly what was about to happen? What if I told you there's a hidden dimension to trading that most retail investors completely overlook, yet it reveals the true intentions of smart money days or even weeks before major price movements occur? When most traders analyze the markets, they obsess over candlestick patterns, support and resistance levels, and an endless array of technical indicators. But they're only seeing half the picture. There's a critical second dimension hiding in plain sight on every chart platform in existence. Volume, the silent narrator that reveals what's really happening beneath the surface of price action. Has this ever happened to you? You spot what looks like the perfect technical setup. The chart formation is textbook. All your favorite indicators are aligned. You enter the trade with confidence, only to watch it immediately move against you while other traders seem to exit at precisely the right moment. That disconnect happens when you're ignoring the crucial message that volume is sending. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Stay with me until the end of this video, because what you're about to discover might fundamentally change how you analyze any market. At the very core of Wyckoff's methodology lies his revolutionary law of effort versus result. This powerful concept states that for every action in the market, there is a reaction, and the nature of that reaction reveals the underlying balance of power. In this relationship, volume represents the effort, while price movement demonstrates the result. When effort and result are in harmony, such as rising prices on expanding volume, the market is confirming its direction. But what's truly fascinating, and what gives you an extraordinary edge, is when they fall into disharmony. These divergences between price and volume provide some of the most reliable early warning signals in all of technical analysis. What if you could learn to spot these footprints before the big moves happen? What if you could see what the institutional players, what Wyckoff called the composite man, are doing, while the majority of traders remain completely unaware? The relationship between price and volume isn't merely a correlation. It's a window into the mind of smart money in the market. Volume reveals their hand, showing when they are accumulating or distributing positions, often right under the noses of unsuspecting retail traders. In the next few minutes, I'm going to show you how to decode this secret language that predicts virtually every significant market move. In the world of market analysis, there's a hidden truth that separates consistently profitable traders from those who struggle to maintain an edge. Wyckoff understood that behind every market movement, there exists what he called the composite man, a conceptual representation of all the smart money and institutional players operating in concert, as if they were a single entity with definite plans and objectives. This composite man isn't just a theoretical concept, it's a practical framework for understanding how big money operates. Think about it. Large institutions cannot accumulate or distribute massive positions without leaving footprints. Their very size requires them to operate over extended periods, carefully disguising their true intentions while they methodically build or unload positions. And the most revealing trace of their activity? Volume. If you want to master the art of reading volume patterns like this, hit that subscribe button. I'm constantly sharing these hidden market insights that most traders miss completely. The true transformation in your trading journey begins when you stop seeing the market as random price fluctuations and start recognizing these deliberate campaigns of accumulation and distribution. It's like developing X-ray vision that allows you to see through the surface-level price action and into the underlying reality of who's actually in control. Let's talk about the profound revelations that come from understanding harmony and disharmony in the price-volume relationship. When volume and price are in harmony, they tell the same story. Rising prices with expanding volume confirms buying pressure is genuine. Falling prices with increasing volume validates that selling pressure is real. This alignment creates a sense of market confirmation, a verification that the visible price action accurately reflects the underlying forces at work. But the most powerful signals, the ones that can truly impact your decision-making, come from moments of disharmony. Imagine a stock that's been climbing steadily, suddenly experiences a day of enormous volume, yet the price barely moves higher or even closes lower. This divergence isn't just a technical anomaly, it's a window into the behind-the-scenes reality of what's really happening. The massive effort, volume, produced minimal results, price movement, a clear indication that significant selling pressure met the buying demand. These moments of disharmony often precede major reversals, providing astute traders with precious early warnings before the majority realizes what's happening. It's like having advanced knowledge of a significant shift in the market's tectonic plates before the earthquake is felt on the surface. The journey to mastering this approach requires shifting your mindset from focusing solely on price to understanding the dynamic interplay between price and volume. Once you train your eyes to spot these patterns, you'll begin recognizing them everywhere. From individual stocks to entire market indices, from daily charts to monthly timeframes. The principles remain consistent across all markets and time periods. Now, I want to go even deeper into this topic by exploring what volume truly represents in its essence. At its core, volume is the purest measure of supply and demand dynamics in any market. But there's much more to understand about how these dynamics unfold in real-time trading scenarios. If you've ever experienced that moment of clarity where a market move suddenly made perfect sense because of the volume pattern that preceded it, write, "I've seen behind the curtain" in the comments below. At its core, volume is the purest measurement of supply and demand dynamics in any market. High volume doesn't just indicate activity, it signifies significant disagreement about a stock's true value. When volume surges, it reveals a genuine battle occurring between buyers and sellers, a momentary clash of conviction about whether the current price is too high, too low, or just right. This is crucial to understand because large institutional players cannot hide their footprints completely when they're actively participating in the market. Think about the illumination that comes from understanding what different volume signatures actually represent. When a stock experiences persistently high volume during a trading range, it's not just random noise. It's evidence of a methodical transfer of ownership taking place. The composite man is either accumulating shares from retail investors who lack the patience to hold through consolidation periods, or distributing shares to an eager public who believes prices will continue rising indefinitely. Equally revealing is when volume suddenly dries up, what Wyckoff called dullness. Low volume isn't just absence. It's presence of a different kind. Sometimes it indicates genuine lack of interest, but often it represents a deliberate strategy by large operators to discourage public participation. They create this dullness on purpose, making the stock appear boring while they quietly accumulate shares before the next significant move. This insight transforms how you perceive those seemingly dead periods in charts that most traders ignore completely. To truly master the art of reading volume, We need to journey behind the scenes to understand a technique that Wyckoff himself considered essential: tape reading. In Wyckoff's era, traders would analyze the character of volume as it printed moment by moment on the stock ticker tape. This wasn't just about the total volume for the day, but about understanding the subtle texture and quality of that volume throughout the trading session. The true revelation comes when you realize that not all volume is created equal. Wyckoff understood that the size of individual trades revealed powerful clues about who was acting in the market. Large blocks, trades of 1,000, 5,000, or even 10,000 shares, were almost always the footprints of the composite man, the professional operators. The average retail trader simply doesn't have the capital to trade in such sizes. These large blocks on the tape provide a direct window into the actions of smart money. Imagine watching a stock declining, and suddenly you see several large blocks being purchased at the bid price, absorbing the selling pressure. This isn't random, it's a deliberate accumulation strategy. Conversely, if a stock is rallying and you notice large blocks consistently being offered for sale, capping every advance while the buying is predominantly in small lots from an excited public, you're witnessing distribution in real time. The mindset transformation comes when you begin to distinguish between informed professional action and uninformed public reaction. Even in today's digital markets, this principle remains powerful. Modern platforms may not show the ticker tape, but they do provide time and sales data, order flow, and volume profile tools that serve the same purpose, revealing the character of the volume, not just its quantity. Have you ever noticed unusual volume patterns just before a major price move? Type, "I've spotted volume clues" in the comments if you've observed this phenomenon even before understanding its significance. This brings us to one of the most misunderstood yet opportunity-rich volume signatures in the market: the selling climax. At market bottoms, after a prolonged decline has exhausted most buyers and negative sentiment reaches extreme levels, we often witness a dramatic event. A day of exceptionally wide price range, accompanied by an explosive surge in volume. To the untrained eye, this massive volume on a day of sharp decline looks terrifyingly bearish. The natural emotional response is fear, leading many traders to panic sell at precisely the wrong moment. But the trained Wyckoff analyst sees something entirely different: a massive transfer of ownership from weak, fearful hands into strong, patient, well-informed hands. This paradox creates extraordinary opportunity. Remember the fundamental truth of markets: for every share sold, there must be a buyer. The immense volume of a selling climax isn't just panic selling, it's equally powerful buying. The composite man uses public fear as his opportunity to acquire shares at bargain prices. The high volume represents tremendous effort, and the result is that the price stops declining, often closing well off the lows of the day. These climactic moments represent significant turning points, but they're disguised as chaos. They're the market's way of testing your conviction and emotional resilience. If you can recognize a selling climax for what it truly is, the exhaustion of selling pressure rather than its confirmation, you gain a tremendous edge that few traders ever develop. The journey toward mastery continues with what happens after this climactic event. After witnessing a selling climax, the next critical revelation in the Wyckoff methodology comes with what's called the secondary test. This event occurs when price drifts back down to retest the low established during the climax, and its volume signature is absolutely crucial for confirmation. For the secondary test to be valid, it must occur on volume that is a mere fraction of what was seen during the climax itself. This dramatic shrinkage of volume is the hidden truth that selling pressure has been exhausted. It confirms that the panic is over, that fear no longer dominates market psychology. When you see this pattern unfold, a climactic high-volume decline followed by a retest on significantly lower volume. You're witnessing one of the most reliable bottoming formations in all of technical analysis. Throughout the entire accumulation phase that follows, this same principle applies. The most important bullish volume signature during accumulation is the gradual drying up of supply on reactions. On each swing down towards support, volume should progressively lighten. Wyckoff emphasized that dullness after a decline is actually a sign of strength, counterintuitive as that might seem to most traders. This pattern creates the heartbeat rhythm of healthy accumulation, expanding volume on rallies and contracting volume on reactions. It's the market's way of telling you that demand is quietly but persistently gaining control, that the composite operator is successfully absorbing the floating supply. Behind the scenes, a transformation is occurring in the ownership structure, from weak hands to strong. If you've ever sold in panic during a market bottom only to watch the price recover, shortly after, type "I've learned this lesson" in the comments. These painful experiences often become our greatest teachers on the market journey. As the accumulation campaign nears its end, we often see one of the most fascinating manipulative events in all of market behavior, the spring or shakeout. The spring is a sharp thrust below the support of the trading range, designed specifically to mislead the public and trigger their stop-loss orders. It's at this precise moment that volume reveals its most powerful insights and offers an extraordinary opportunity for the perceptive trader who understands what's actually happening behind the scenes. A spring that occurs on conspicuously low volume is one of the most bullish signals possible. The price breaks support, where one would expect to trigger a wave of stop-loss selling, but instead finds a vacuum. This lack of selling pressure is definitive proof that supply is exhausted. The stock has been so thoroughly accumulated that there's simply no one left to sell, even at prices below the established support. This revelation can transform your perspective on what appears to be a breakdown, but is actually the final stage before a significant advance. Equally telling is a spring on high volume that quickly reverses. In this case, the break below support does trigger significant selling, but the price refuses to continue lower and rapidly returns to the trading range. This shows that the composite operator was present with buying power great enough to absorb this final wave of selling. It's the last gasp of supply being consumed by demand. These springs represent the final cleansing of weak hands before a significant advance can begin. They're the ultimate test of supply, designed to ensure that the stock is ready for markup. When you learn to recognize these volume signatures, you gain insight into market manipulation tactics that most traders never see. The journey from being manipulated to recognizing manipulation represents one of the most profound mindset shifts in your trading evolution. Instead of being victimized by these tactics, you begin to anticipate them and even use them to your advantage. After the long process of accumulation and the final spring that confirms supply exhaustion, the market finally reaches the moment many traders eagerly await, the breakout. What Wyckoff colorfully called the jump across the creek is that decisive move above the resistance of the trading range, signaling the beginning of the markup phase. But here's where many traders make a critical error in judgment. They focus solely on the price action of the breakout while ignoring its volume signature. The truth is that volume confirmation for a breakout isn't optional. It's absolutely non-negotiable. A genuine valid breakout must be accompanied by a substantial and sustained increase in volume. This is the direct application of the law of effort versus result that we discussed earlier. The breakout represents a significant result, and it requires significant effort in the form of high volume to be considered legitimate. This surge in volume reveals multiple layers of market psychology converging at once. It shows that the composite operator is no longer accumulating quietly, but is now willing to bid the price up aggressively. It represents the recognition from other professional traders who see the technical signal, and it includes the forced buying from short sellers who suddenly find themselves trapped on the wrong side of the move. This confluence of demand creates the power needed to overcome the natural supply that exists at resistance. What's particularly illuminating is what happens when a breakout occurs on low or average volume. Despite what conventional technical analysis might suggest, such a move is highly suspect. It reveals a lack of conviction and suggests there simply isn't enough demand to sustain the advance. These low-volume breakouts often become bull traps, deceptive moves designed to lure in unsuspecting traders before quickly reversing course. If you've ever been caught in what seemed like a perfect breakout only to watch it fail immediately after entering, type "I've been trapped before" in the comments. Following a genuine breakout, we typically see a pullback to test the old resistance level as new support. What Wyckoff colorfully called the "back up to the edge of the creek." The volume signature here is equally critical for determining whether the breakout will ultimately succeed or fail. A successful test must occur on dramatically shrinking volume, proving that the supply that was previously present at this level has been removed and sellers are no longer a threat. This declining volume on the pullback creates a powerful revelation about the market's new psychology. What was once considered expensive, resistance, has now been accepted as value, support. The lack of aggressive selling during this retest confirms this paradigm shift. This low-volume test offers one of the safest entry points for those who missed the initial breakout, a second chance that often has an even better risk-reward ratio than the original breakout. The clarity that comes from recognizing this pattern transforms your approach to trading breakouts entirely. Rather than chasing the initial surge higher, which often puts you at risk of buying right when short-term traders are taking profits, you can patiently wait for the inevitable pullback, confident in your ability to distinguish between a healthy retest and a failed breakout through volume analysis. The journey doesn't end with a successful breakout and retest. Once the markup phase begins, the stock should establish a rhythm, a pattern of higher highs and higher lows that defines a healthy uptrend. Volume plays a crucial role in confirming the sustainability of this advance, providing ongoing intelligence about whether smart money remains committed to the move. A strong, reliable uptrend has a very specific volume signature that reveals its underlying health. Volume should expand on rallies and contract on reactions. As the stock pushes to new highs, expanding volume shows that buying enthusiasm remains strong, and that demand is easily overcoming any profit-taking. When the inevitable pullbacks occur, contracting volume proves that the selling is merely passive profit-taking from weaker hands, rather than aggressive distribution from the composite operator. This creates a profound revelation for patient investors. As long as this harmonious rhythm between price and volume continues, there's a strong logical foundation for holding positions and allowing profits to run. The volume confirms that the balance of power remains firmly in the hands of buyers, that the path of least resistance continues to be higher. The mindset shift required here is from seeing market moves as random fluctuations to recognizing them as logical campaigns with beginnings, middles, and eventually endings. Each phase has its own unique volume signature that confirms its legitimacy. By aligning yourself with these signatures rather than fighting against them, you position yourself to capture the largest and most sustainable portions of major market moves. This harmonious relationship between price and volume in uptrends is perhaps the clearest demonstration of Wyckoff's law of cause and effect. The cause, the accumulated buying pressure established during the trading range, expresses itself in the effect, the sustained advance with specific volume characteristics. The significance of this pattern extends beyond just technical confirmation. It provides psychological reassurance that you're on the right side of the market's dominant force. If you've ever exited a position too early during what turned out to be a sustained uptrend, type "I left money on the table" in the comments. Understanding these patterns can help overcome the psychological barriers that lead to premature exits. Just as markets create bottoming structures through accumulation, they also form topping patterns through a process called distribution. This is where the symmetry of market cycles reveals itself in fascinating ways. The first dramatic warning sign of a major market top is what's known as the buying climax, the mirror image of the selling climax we discussed earlier. The buying climax occurs at the end of a long, often accelerated advance. When public enthusiasm has reached a fever pitch, the news is universally positive. Social media is buzzing with success stories. Financial media features endless bullish commentators, and the fear of missing out drives the last wave of uninformed buyers into the market in a final frenzied rush. It's precisely this moment of maximum optimism that the composite man has been patiently waiting for. After quietly accumulating at much lower prices, he now meets this euphoric demand with an overwhelming wave of supply. He feeds his enormous line of stock into the eager hands of the public, who believe prices can only continue higher. The transformation from bull to bear happens right under the noses of most market participants, disguised as strength rather than weakness. On a chart, this event appears as a day of extremely wide price range, accompanied by climactic, often record-breaking volume. What makes this pattern so revealing is that the price typically surges to a new high early in the session, but then stalls and closes well off the peak. This represents the ultimate disharmony between effort and result. The tremendous effort, climactic volume, has failed to produce a corresponding result, a strong close. This failure to hold gains is irrefutable evidence that the buying demand, as powerful as it was, met and was overcome by an even more powerful wave of selling supply. This event marks a profound shift in market psychology. The first revelation that buying power may be exhausting itself. Yet to the untrained eye, the enormous volume on a day that made a new high often appears bullish rather than bearish. The public interpretation is precisely opposite to the reality of what's occurring behind the scenes. Following the buying climax and the subsequent automatic reaction, the initial sharp decline, the stock enters its distribution range. The journey through this range is marked by volume signatures that are the direct inverse of those seen during accumulation. The most important sign of a distribution top is that volume expands on declines within the trading range and contracts on rallies, exactly opposite to the healthy accumulation pattern. An increase in volume on sharp reactions within the range shows that supply is becoming aggressive. When the stock attempts to rally back toward the highs, the volume becomes conspicuously light. This drying up of volume on rallies is a critical warning sign. It proves there's a lack of genuine, professional demand. The buying power has been exhausted, and the public lacks the financial capacity to absorb the large blocks of stock being offered by informed interests. Perhaps the most telling signature is the repeated failure of the stock to make significant upward progress despite high volume. The price may churn and show great activity near the top of the range, but it fails to advance higher. This churning action with high volume but no upward progress is the very definition of distribution, the effort-result disharmony that signals a major shift in the balance of power. If you've ever watched a stock or the overall market struggle to make new highs despite seemingly positive news and high trading volume, type "I've witnessed distribution" in the comments below. As the distribution campaign nears its completion, the composite man often employs one final deceptive maneuver to extract maximum profit: the upthrust. This is the bearish mirror image of the spring we discussed earlier. While a spring is a false breakdown designed to shake out weak holders, an upthrust is a false breakout engineered to trap the last remaining bulls and lure in new buyers at precisely the wrong moment. The upthrust appears as a sharp price move above the resistance line of the trading range that is specifically designed to fail. Its purpose is to create a final illusion of strength, encouraging breakout buyers to jump in while triggering the stops of any remaining short. Sellers. This burst of artificial demand provides the composite operator with the perfect opportunity to sell the last of his holdings at optimal prices before the decline begins. The volume signature on an upthrust provides the critical clue to its true nature and reveals the deception at work. An upthrust on suspiciously low volume is a clear warning sign of weakness. It shows there's no genuine demand behind the breakout attempt, just a manipulative push designed to create the appearance of strength. Even more revealing is an upthrust on high, even climactic volume that fails to produce any further upward progress. This represents one of the most powerful signs of distribution, showing that even an enormous effort couldn't produce a sustainable result. The confirmation of the upthrust comes with the price's swift failure to hold its gains, quickly falling back into the trading range. This confirmed failure offers one of the most reliable signals to exit all long positions and potentially initiate short positions in anticipation of the new downtrend. It's a strategic revelation about the market's true direction that most traders miss entirely because they've been conditioned to view breakouts as inherently bullish events. Once distribution is complete and ownership has transferred primarily to uninformed hands, the path of least resistance becomes definitively downward. The markdown phase begins with the breakdown, what Wyckoff called falling through the ice. The volume signature on this initial break of support is absolutely critical for confirmation. A valid breakdown must be accompanied by a significant and sustained increase in volume. This shows that sellers are aggressive and that there's powerful force behind the new downtrend. The expanding volume provides the necessary effort to produce the result of prices falling below long-established support. A breakdown attempt on low volume, however, is highly suspect and may simply be another shakeout, rather than the beginning of a major decline, a crucial distinction that volume analysis makes possible. After the initial breakdown, there's often a rally back to the underside of the old support line, which now acts as new resistance. Wyckoff called this the last point of supply, LPS, and it's one of the most dangerous points in the entire market cycle for those unaware of its significance. The volume behavior during this rally provides the final confirmation of the breakdown's validity. A test of the broken support on light, diminishing volume is an extraordinarily bearish sign. It proves that buying power has been exhausted and that demand is simply not strong enough to push the price back into its old trading range. Once a downtrend is firmly established following a valid breakdown, understanding its rhythm becomes critical for both traders with short positions and those waiting patiently for the eventual bottom. Just as uptrends have a specific volume signature that confirms their health, downtrends possess their own rhythmic pattern that reveals their strength and sustainability. If you've ever spotted a false breakout or been trapped by one, drop a comment saying, "I've survived an upthrust." These experiences, while painful, build the market intuition that eventually leads to consistent profitability. As we've journeyed through the secret language of volume together, I hope you've begun to see the markets in a new light. Volume isn't just a secondary indicator. It's the force that drives all significant price movement. It reveals the hidden truth behind every advance and decline, every accumulation and distribution phase. The ability to read this language gives you an edge that most traders never develop. The ability to see the market through the eyes of the composite operator. This approach to market analysis isn't just about technical patterns. It's about developing market intuition and understanding the psychology that drives prices. When you learn to interpret the relationship between price and volume through the lens of effort versus result, you're no longer just following the crowd. You're anticipating moves before they happen, recognizing the footprints of smart money as they quietly build positions or methodically distribute them. If you found value in this perspective on volume analysis, hit the like button. It's a small gesture that helps others discover this content who might benefit from it too. And if you're not already part of our community of thoughtful traders and investors, subscribe to join others who are focused on understanding markets at a deeper level rather than following the latest fads. I'm curious which of these volume patterns you've already noticed in your own trading without realizing their significance. Drop a comment with "I speak volume" if you've made it to the end and are starting to see markets through this new lens. There's a video right here that builds on what we've discussed today, exploring how to identify the specific price patterns that often accompany these volume signatures. Click and continue with me over there to complete your understanding of the Wyckoff methodology and take your market analysis to the next level.